Iran war escalates. Silver $120. Gold $6,000 dark market. Oil spike. But here's what they're not telling you. China just shut down gold trading. The dark market hit $6,000 per ounce. While you were sleeping, physical silver in Shenzhen crossed $120. Small distributors refusing to sell. They know something. The aircraft carrier Abraham Lincoln targeted. 165 ballistic missiles launched. And the supreme leader gone. This isn't a drill anymore. The financial reset has begun. What happens Monday morning when markets open could change everything you thought you knew about money. Welcome back to Currency Archive, where we preserve the financial truth before it gets erased. Listen, I know many of you watching this. You've seen markets rise and fall for decades. You've lived through crashes, wars, recessions. You understand that real wisdom comes from experience. So I'm asking you, as someone who respects your journey, hit that subscribe button, not because I'm begging, but because at your age, at your level of understanding, you deserve a channel that doesn't treat you like a child. And drop a comment below. Tell me where you're watching from. Are you in the States, Europe, Asia? Because what's coming affects every corner of this world. Let's dive in. The financial world operates on a simple principle. When markets close, price discovery stops. Or at least, that is what traditional theory suggests. What occurred over the weekend of the Iranian strikes revealed a different reality, one that most investors were not prepared to witness. Iranian state media confirmed the death of Supreme Leader Ali Khamenei following coordinated airstrikes. Former President Mahmoud Ahmadinejad was killed in a separate attack. These were not rumors circulating on social media. These were official confirmations from state broadcasters. Two of the most powerful figures in Iranian leadership eliminated within hours of each other. The immediate response was not de-escalation. Iran launched 165 ballistic missiles, 2 cruise missiles, and 541 drones. 152 ballistic missiles were intercepted. 56 drones were destroyed mid-flight, but 35 drones reached their targets. 21 struck civilian infrastructure. 3 people were killed. 58 were injured across multiple nationalities. Then Iran targeted the USS Abraham Lincoln, a United States aircraft carrier. 4 ballistic missiles were fired directly at the vessel. The Iranian Revolutionary Guards confirmed the strike through official channels. Whether those missiles connected or were intercepted remained unclear in the immediate aftermath. What became clear was that traditional red lines no longer existed. Markets were closed. It was Saturday. Stock exchanges in New York, London, and Frankfurt were dark. Gold futures trading was halted. Silver markets were offline. Under normal circumstances, the world would wait until Monday morning for price discovery. But something unusual began happening in the shadows of the traditional financial system. China's Dashang Bank issued an emergency notice. The statement was direct. If price deviations led to the depletion of accumulated gold liquidity, trading would be suspended immediately. The bank acknowledged that a massive amount of yuan-denominated savings were waiting for Monday's market opening. Chinese investors were preparing to move capital the moment exchanges reopened. While official markets remained closed, the dark market for physical gold touched $6,000 per ounce. This was not yuan-denominated pricing. This was US dollar pricing for actual physical metal, not paper contracts, not futures. Physical gold changing hands in private transactions at prices nearly 15% above Friday's official close. Observers who understood tokenized assets noticed something equally striking. PXG, a cryptocurrency token backed by physical gold, reached $5,600 per ounce on Saturday. By Sunday evening, it was trading at $5,400. Friday's official spot close had been $5,278. The premium was $124 per ounce. This premium existed because cryptocurrency markets never close. They operate continuously. When fear enters the system and traditional markets are unavailable, those with access to 24-hour trading platforms will pay premiums, significant premiums. The situation in China's physical silver markets told an even more concerning story. A commodities trading advisor in Shenzhen documented what was happening on the ground. The physical silver buyback price premium between small distributors had jumped almost $20 per troy ounce equivalent. This pushed the actual transaction price for physical silver in Shenzhen above $120 per ounce. Most small Chinese silver distributors were refusing to sell their inventory entirely. The reason was simple. They feared supply shortages. They understood that once their physical metal was sold, replacing that inventory might be impossible at any price. This behavior indicated something deeper than simple profit-taking. It revealed a breakdown in confidence regarding supply chains. Traditional weekend-to-spot trading platforms showed the same pattern. IG's weekend silver trading approached $100 per ounce. Hyperliquid data showed $96. These were not official prices. They were weekend approximations. But they reflected real transactions between parties willing to accept weekend pricing rather than wait for Monday's official open. What emerged over that weekend was a two-tier pricing system. There was the official price, the last recorded price before markets closed on Friday. Then there was the actual price, the price at which physical metal was changing hands in real transactions during the market closure. The gap between these two prices told a story that would become clear only when Monday arrived. The question facing every serious investor was not whether prices would rise. The question was whether the traditional pricing system itself would remain functional, or whether the dark market prices would become the new standard. The weekend was over. Monday morning approached, and nobody knew what would happen when the bell rang. The concept of premium pricing is not unusual in commodity markets. During periods of high demand, buyers pay slightly more than spot price to secure immediate delivery. A 2% premium is normal. 5% indicates stress. What occurred in Shenzhen's physical silver market was neither normal nor simple stress. It was a fundamental breakdown in price discovery mechanisms. Small distributors in China's southern manufacturing hub were offered premiums approaching $20 per troy ounce above the official spot price. To understand the magnitude, one must consider that silver's Friday close was approximately $32 per ounce. A $20 premium represented a 62% markup. Yet distributors were not selling. They were holding inventory despite offers that would have generated extraordinary profits under normal market conditions. This behavior defied basic economic theory. When prices rise, suppliers sell. When premiums expand, inventory moves. But Shenzhen's small distributors were operating under a different calculation entirely. They understood something that spreadsheet models could not capture. Physical metal in hand was worth more than any paper profit. The actual transaction price for physical silver in Shenzhen exceeded $120 per ounce. This was not a theoretical price. This was the price at which actual metal changed hands between parties who needed immediate possession. The gap between official spot pricing and real-world transaction prices had grown so wide that two completely separate markets were operating simultaneously. Across the Pacific, tokenized gold markets were revealing similar patterns. PXG tokens, each representing ownership of physical gold stored in verified vaults, were trading between $5,400 and $5,600 per ounce throughout the weekend. The official Friday spot close had been $5,278. The premium ranged from $122 to $322 depending on the hour. What made this premium particularly significant was its persistence. Premiums typically spike during moments of panic and then collapse as rationality returns. But the PXG premium held throughout Saturday and Sunday. It did not contract. It stabilized at elevated levels. This indicated that buyers were not panic purchasing. They were making calculated decisions to pay premiums rather than wait for traditional market opening. The Chinese banking system's response added another layer of complexity. Dashang Bank's notice regarding potential trading suspensions was not merely precautionary language. The bank was acknowledging that its accumulated gold liquidity pools could be depleted entirely if price movements continued. This meant the bank did not have sufficient physical gold to settle all potential redemptions at current demand levels. Massive yuan savings were documented waiting for Monday's opening bell. Chinese investors had moved cash into position. They were not waiting to buy paper gold certificates or futures contracts. They were preparing to convert yuan into physical metal claims the moment exchanges allowed such transactions. The scale of this waiting capital created a dangerous dynamic. If even a fraction of these yuan savings attempted to convert into physical gold claims simultaneously, the settlement system could face immediate strain. Banks operate on fractional reserve principles. They hold some physical metal, but rely on the assumption that not all claim holders will demand physical delivery at once. What happened when that assumption proved incorrect was well documented in historical banking crises. The difference in this scenario was that investors were not reacting to rumors or irrational fear. They were responding to confirmed geopolitical events and observable market dislocations. Meanwhile, platforms offering weekend precious metal trading showed price action that defied normal weekend patterns. IG's weekend spot, silver trading approached $100 per ounce. Hyperliquid showed $96. These platforms existed specifically to provide price discovery during traditional market closures. What they discovered was profound dislocation. The pattern was consistent across multiple platforms and geographic regions. Physical metal commanded premiums far exceeding historical norms. Small holders refused to sell despite extraordinary profit opportunities. Large institutions issued warnings about liquidity constraints. And continuous trading platforms showed sustained elevated pricing rather than panic spikes followed by corrections. What emerged was not a temporary market inefficiency to be arbitraged away. It was the formation of a parallel pricing system. The official system, governed by exchange rules, settlement procedures, and regulatory oversight, was showing one price. The physical system, governed by supply, demand, and immediate possession, was showing another price entirely. The gap between these two systems was not measured in percentage points. It was measured in fundamental questions about which price actually mattered. When investors needed metal in hand rather than promises of future delivery, they paid physical market prices. When they were willing to accept paper claims, they paid spot market prices. Monday's opening would reveal which system held authority. The answer would reshape how precious metals were priced and how serious investors thought about ownership itself. Energy moves differently than precious metals. Gold can sit in a vault for decades without losing value. Silver can be stored indefinitely, but oil must flow continuously. Refineries require constant feedstock. Transportation networks depend on uninterrupted supply. Manufacturing facilities cannot stockpile months of energy reserves. When oil supply faces disruption, the effects cascade through every layer of the global economy within days, not months. Iran produces approximately 3.8 million barrels of oil per day. Under normal circumstances, this represents roughly 4% of global supply. That percentage seems modest until one considers the geographic choke point through which much of this oil must pass. The Strait of Hormuz, a narrow waterway between Iran and Oman, carries approximately 21 million barrels per day. That is 21% of global petroleum consumption flowing through a passage just 21 miles wide at its narrowest point. The strikes that eliminated Iranian leadership did not immediately halt oil production. Wells continued pumping. Refineries continued operating. But the targeting of the USS Abraham Lincoln changed the calculus entirely. When a nation fires ballistic missiles at a United States aircraft carrier, the carrier group does not withdraw. It reinforces. And when carrier groups reinforce in the Strait of Hormuz, insurance rates for tanker traffic change dramatically. By Sunday evening, shipping insurers were recalculating risk premiums for vessels transiting the strait. Early indications suggested rate increases between 300 and 500% for standard coverage. Some insurers were declining to offer coverage entirely until the military situation stabilized. Tanker operators faced a choice: transit without insurance or wait indefinitely for conditions to improve. Neither option was sustainable. Oil tankers operate on tight schedules. Delays of even 48 hours create supply chain disruptions at destination refineries. If tankers began avoiding the strait entirely and rerouting around Africa's Cape of Good Hope, transit times would increase by 2 to 3 weeks. Global oil inventory systems are not designed to absorb 3-week delays across 21% of daily consumption. Futures markets were closed for the weekend, but forward pricing in accessible markets told a clear story. Brent crude futures for contracts trading in accessible venues showed increases approaching $40 per barrel. West Texas Intermediate showed similar movements. These were not minor adjustments. These were prices reflecting genuine supply disruption fears. The secondary effects were already visible in corporate behavior. Airlines began emergency hedging operations through whatever markets remained open. Shipping companies activated force majeure clauses in delivery contracts. Chemical manufacturers, whose production costs are heavily energy dependent, started communication with customers about potential price adjustments. What made this energy shock different from previous disruptions was its timing. The global economy was already managing inflationary pressures. Central banks had spent the previous 2 years raising interest rates to control price increases. Energy costs feed directly into inflation calculations. Transportation costs rise. Manufacturing input costs rise. Consumer goods prices rise. The inflation that central banks had worked to contain would accelerate regardless of monetary policy decisions. This created an impossible situation for central banking authorities. Traditional economic theory suggests raising interest rates to combat inflation. But raising rates during a supply shock caused by geopolitical conflict does not increase oil supply. It simply damages economic growth while energy prices continue rising. The alternative, maintaining current rates or cutting them, would allow inflation to accelerate unchecked. Nations heavily dependent on energy imports faced particularly acute pressures. Japan imports approximately 96% of its oil. South Korea imports 94%. European nations collectively import roughly 90%. These economies had no domestic production buffers. They were entirely exposed to global price movements and supply disruptions. Strategic petroleum reserves existed precisely for scenarios like this. The United States maintains roughly 370 million barrels in strategic storage. At current consumption rates of approximately 20 million barrels per day, this represents roughly 18 days of total supply. Other nations maintain similar reserves scaled to their consumption. But strategic reserves are designed for temporary disruptions, not sustained conflicts. If the Strait of Hormuz situation extended beyond weeks into months, strategic reserves would deplete. At that point, prices would be determined entirely by available supply and demand desperation. Historical precedent from the 1973 oil crisis showed what happened when energy supply faced geopolitical disruption. Prices quadrupled. Rationing was implemented. Economic recessions followed despite government intervention. The current situation carried additional complexity that 1973 did not face. Global debt levels were substantially higher. Derivatives markets were exponentially larger and more interconnected. Supply chains were optimized for efficiency rather than resilience. The financial system was more leveraged and less tolerant of sustained shocks. Russia and Saudi Arabia, the world's other major oil producers, were watching carefully. Their response would determine whether this crisis remained containable or evolved into something more systemic. If they increased production to offset Iranian disruptions, prices might stabilize. If they maintained current production levels or reduced output, prices would continue climbing. Early indications suggested neither nation was rushing to increase production. The geopolitical calculations were complex. Higher oil prices, central banks operate under a fundamental assumption that monetary policy tools can influence economic outcomes. Interest rates can be raised to cool inflation. Rates can be lowered to stimulate growth. Currency supply can be expanded or contracted. These tools work effectively in peacetime economies where supply chains function normally and geopolitical stability allows predictable trade flows. What happens when these assumptions no longer hold is a question most central bankers hoped never to answer practically. The Federal Reserve, European Central Bank, and Bank of Japan now faced a scenario their models were not designed to address. Inflation was accelerating due to energy supply disruption. Raising interest rates would not increase oil supply. It would simply make borrowing more expensive while energy costs continued rising. Lowering rates would provide no relief to businesses facing tripled transportation costs. Monetary policy tools were designed for demand-side problems. This was a supply-side crisis. The dollar's role as global reserve currency was being tested in real time. Historically, during international crises, capital flowed into dollar-denominated assets as a safe haven. Investors sold riskier holdings and bought U.S. Treasury bonds. The dollar strengthened. But the current crisis was different. The United States was directly involved militarily. Its aircraft carrier had been targeted. Its response would likely involve further military action. Under these conditions, the dollar was not necessarily the safest harbor. Evidence of this shift appeared in currency markets that remained open during the weekend. The Swiss franc strengthened significantly against the dollar. The Japanese yen showed unusual strength despite Japan's energy import vulnerabilities. These movements suggested that investors were differentiating between traditional safe havens and currencies issued by nations directly involved in the conflict. More significantly, alternative settlement systems were being utilized at unprecedented volumes. China's cross-border interbank payment system, designed as an alternative to SWIFT, processed record transaction values over the weekend. Russian banks increased usage of domestic payment systems. Nations that had previously conducted most international trade in dollars were executing bilateral settlements in local currencies. This fragmentation of the international payment system carried profound implications. The dollar's reserve currency status was not guaranteed by law or treaty. It existed because parties globally agreed to use dollars for international transactions. If that agreement eroded, if nations increasingly settled trade in alternative currencies or systems, the structural demand for dollars would decline, and with it, the United States' ability to run sustained fiscal deficits without consequence would diminish. Institutional investors were repositioning portfolios in ways that reflected these systemic concerns. Wealth preservation had become the primary objective rather than return maximization. Traditional asset allocation models recommended 60% stocks and 40% bonds, but those models assumed functioning markets and stable geopolitical conditions. Neither assumption currently held. What sophisticated investors were doing instead was diversifying across asset classes that performed independently of traditional financial markets. Physical precious metals, agricultural land, energy infrastructure, assets with intrinsic value that did not depend on counterparty performance or government stability. The weekend's price action in gold and silver was not speculative momentum. It was strategic repositioning by parties who understood systemic risks. Monday morning would reveal whether the weekend's pricing represented temporary dislocation or permanent repricing. If traditional markets opened and prices quickly converged with official spot levels, the system would demonstrate resilience. Arbitrageurs would profit from the weekend premiums. Order would be restored. But if physical premiums persisted, if the gap between paper prices and physical transaction prices remained wide, it would confirm that a parallel pricing system had emerged. For business leaders and corporate treasury managers, the implications were immediate and practical. Currency exposure that seemed manageable on Friday was potentially catastrophic by Monday. A A company with significant euro-denominated debt but dollar-based revenues faced different risks than a company with the opposite exposure. Energy-intensive manufacturing faced input cost increases that could not be immediately passed to customers. Supply chains, optimized for cost efficiency rather than resilience, were vulnerable to disruption at multiple points. Strategic recommendations for serious business operators were becoming clear. First, reassess currency exposure across all operations. Contracts denominated in single currencies carried concentration risk. Natural hedges through diversified revenue and cost streams provided more stability than financial derivatives. Second, evaluate energy cost sensitivity. Businesses with high energy inputs needed immediate hedging strategies or operational adjustments. Waiting for clarity would mean accepting whatever prices the market demanded. Third, consider physical asset allocation and corporate treasury management. Holding excess cash in bank deposits or money market funds provided liquidity but no protection against currency devaluation or banking system stress. Allocating a portion of treasury reserves to physical precious metals or other tangible assets provided insurance against systemic breakdown. Fourth, prioritize supply chain diversification over cost optimization. Single-source suppliers and just-in-time inventory systems maximized efficiency in stable environments. They became catastrophic vulnerabilities during disruptions. Fifth, develop scenario plans for sustained instability rather than assuming rapid resolution. Most corporate planning assumed disruptions would be measured in weeks. The current situation could extend for months or years. Plans needed to address how operations would function under sustained elevated energy costs, restricted international payment systems, and potential material shortages. Historical analysis provided limited guidance because previous crises occurred under different structural conditions. The 1973 oil crisis happened when global debt levels were a fraction of current levels. The 2008 financial crisis was primarily a banking system failure rather than a geopolitical supply shock. The current situation combined elements of both while adding complexity from interconnected derivatives markets and fragmented international payment systems. What separated this crisis from previous disruptions was the simultaneity of pressure points. Energy supply faced disruption. Precious metals markets showed pricing breakdown. International payment systems were fragmenting. Currency